I want to get straight to the heart of the matter, which is it time to de-risk? Deutsche Bank are shifting their global portfolio from 50% equities to 40%. You, however, make the very key point, global equity valuations at 15.1 times earnings are still below the long-term average. Are you beginning to pair risk, or do you still believe that there's mileage to go?
Well, first of all, the performances that we've seen this year in equity markets have really been driven by quality equity, what we would identify in our investment process as companies with very high cash flow returns on investment. And they have been performing very strongly. So I think in some ways, some investors may already have switched away and moved towards quality in terms of preparing for that lower growth environment which continues around us in the world. Secondly, what is interesting is actually that cyclical stocks, despite the poor results that we're now seeing coming into the second quarter, have also been very strong performers since the beginning of the year, possibly on expectations that the second half of this year can show better results than the first part of this year, notably on the basis of a lower base. So 2018 results for the second half are obviously much weaker. And also perhaps that in this new environment that we're getting used to, where you have support from central banks and where you continue to have growth, but at a low level, you don't have any excesses at any point. We don't have a huge boost in capital expenditure, and we haven't had that in any case since the great financial crisis, which would lead to the traditional boom and bust cycle that we've had in previous years. If we look out to 2020, there doesn't seem to be much fear at the moment of a recession in 2020, and that means that shifting away from risk may not necessarily be the best strategy to have, but rather looking for quality investments in companies which can benefit from medium growth going forward.
Yeah, and talking about specific companies then, Eleanor, I just want to bring up Richemont on the one hand and Novartis on the other, because I know when we've talked to you previously, you've expressed an interest in healthcare and luxury. Given what we've heard from both today, Novartis boosting its profit outlook for the second time on new medicines, Richemont perhaps a little bit more concerning. First quarter sales, excluding Yoox Net-a-Porter, missing estimates. Would you want to be holding both these stocks in the portfolio, and if so, why?
So as regards Novartis, certainly that is very encouraging, and as a Swiss portfolio manager, I am of course very pleased to see the improvement that we've been seeing over the last few quarters at Novartis from the operational level. The cash flow returns on investment of the Swiss equity market had dipped over the last few years, notably because of the difficulties that Novartis was facing. To see an improvement there is very encouraging for Swiss investors in general, and obviously for Novartis in particular. They have a good pipeline of new drugs, a couple of drugs coming out in the second quarter which are exciting, notably Zolgensma. So I'm pleased with those results. Also that Sandoz within Novartis has done quite well this last quarter. And indeed, Richemont is not really much of a surprise after the results that were published by Swatch yesterday. Continued weakness on the revenue line, and fortunately a weakness for Switzerland in terms of the specialty watchmakers. And that is something which is proving to be very difficult to turn around. Richemont's jewellery numbers were okay, but there was a continued weakness on the watchmaking, and I found it a little bit disingenuous, if I may, to say that that weakness was due to the tensions in Hong Kong recently, because I'm not sure that that really could have affected the whole of their first quarter, which is our calendar second quarter.